So, hey, good morning everyone. Thanks for joining our webinar today. My name is Nuno Carneiro, and I'm a data scientist at James. And James is a company that's trying to bring the best of data science to every credit risk department. And we're currently building an artificial intelligence for credit risk. And that's what I'm going to do a demo today. So I'm going to show you how you, your business, and your credit union can use the best of James and our technology to better underwrite. That means better selecting who you're going to give loans to, and by that we want you to achieve higher acceptance rates or reduce your charge-off rates. So let's imagine you want to build your own credit risk model. What we'll be doing is we would have collected your data, so the history of loans you have given out in the past, and with those loans, we're going to build a credit risk model. Now, at this stage, I'm going to show you the stage where the data has already been collected, and I'm uploading it to our software. So this is James, our main dashboard. Now create a project I'm going to call Webinar. And I'm going to upload the data here. So you see here, every row on this data file is one loan. So this will be information you get. So let's say this will be loan number 1, and you have here columns that represent the information you get from your credit file, or also information that you get from your members. So for instance, how many loans did they give out in the past, or what's the amount of deposits they have with you. And with this information, we will build a new credit risk model. It takes a few seconds to upload the data. And then once the data is uploaded, we'll have to tell James what the columns mean. So within this file, we need to specify what each column means. And then afterwards, we will be actually doing the modeling work. Okay, a few more seconds, and we're done. All right, perfect. So you see, we got 150,000 rows. This means this particular lender had 150,000 loans in the past, where we already know the outcome, and that's what we're going to use for modeling. We will choose which column represents the application date, and that's this one here. And next, we're going to choose which column represents the target, so what we're trying to predict, and that's delinquency. And where we have a 1, that means there was a delinquent loan. Where we have the zeros, that's the good loans where it didn't become delinquent. Now, this could be, so different credit unions or different financial institutions can have different meanings for delinquency. This is very flexible, as you see, so it could be 30 days delinquency, 60 days delinquency, or whatever other number you have and you want to measure. That will be very flexible. It will be just a matter of dragging and dropping the different numbers into the boxes here. Now, since that's done, we got a menu where we got to choose what the column types are, so whether it's a numerical column or a column with the names, so a categorical column. I'll leave this as the default and click Next. And here we have a few rules that we can set up for our modeling procedures. So imagine if you already have some established rules on modeling from your credit institution, that's the stage where you could set them up. So rules on how many missing values do you allow, or how much do you allow your variables to be correlated. For most credit unions, probably this is not applicable, but in case you have some rules that you have to comply with, that's where you set them up. But, since I don't have any specific rules, I'll leave the standard ones here, and I'll click Next. Okay, so here we got a summary. We know which data set we have, the origination date, and what we're trying to predict here, the target. Now I'm going to create the project. And once the project is created, we can start building models on it. And these are going to be our underwriting models. So each model generates credit scores, and based on that credit score, then you can take decisions, right? If something above 700 score, you accept; below 700, you reject, for example. Now, the important thing here is the better your model, the more accurate it is. So the less charge-offs you will have above your cutoff score, and the more bad loans you have under your cutoff score. And the first decision we can take here is what kind of model do we want to use. And James makes it very easy for you to test different models, and I'm going to show you how to do that. But here on the left side, we have the more classical models. That's the scorecard and logistic regression. But on the right side, we have the machine learning algorithms. So that's where James really shines when we use random forest or gradient boosting algorithms. Those are usually the models that get you the best performance and then allow you to reduce the number of defaults you have or increase your acceptance rate. Therefore, I'm going to start with the random forests, show you how that works. Then next, we have to select an independent test set. That means we're using so we have this 150,000 loans, but we don't want to use all of them. So we're going to partition our data. And here we're already suggested by James to use 80% of those data points for training this model, and 20% which we will be keeping as a separate independent test set to evaluate our performance on. This ensures that we're not overfitting and we're not fitting the data so much that it does not generalize for our population once we use the models in production. Well, and then at this stage, we got a menu where we can do variable selection. And here we see the distributions of all the variables. So you see, for instance, here we have a revolving utilization of unsecured lines. And you see the variable is very concentrated on the left side, and then a lot of values with very low frequency up to 50,000 here. And for instance, age, here you have the distribution of ages for all those loans that you gave out in the past. And one thing you might want to do is transform these variables. And if you want to do that, in particular if you want to create bins, James already provides you the methods for that. You just have to click here on the bin button. And here you see James created bins for the variables. So you have the bin for the ages 21 to 30 years old, 32 years old to 36 years old, and so on. You see the number of good loans in each one of those bins, the number of bad loans in each one of them, the risk rate here. So that means less risk on this side for older applicants, more risk for younger applicants. You could even use different strategies. So if you want to have the same number of loans in each one of the bins, you just choose the equal frequency strategy, and you see same number of loans more or less on each one of the bins. This is all very customizable if you want to do your own strategy. If you don't, we have this optimal algorithm which provides you all you need, the best performance, and you don't have to worry about it. Other interesting things you might want to do for categorical variables, you've got here a variable where the values are employed, self-employed, unemployed. And let's say you want to treat self-employed and unemployed applicants the same way, you'd be able to join the categories here. Okay, see, so now they're grouped, and James or your credit score model will take those applicants and they'll consider them to be the same. And this is especially useful when you have variables with hundreds of categories where none of them is specifically significant. Then you might want to join a lot of them to make a bigger group out of it. Other interesting things is you see here this yellow flag. That means one of the alerts that James is giving you. So it says that these two variables are, so this is a correlation map, and it tells you the correlation is above the limit, a 0.99 correlation, which is very, very high. What this means is these two variables, number of times 90 days late and number of times 69 60 days late, are very correlated. So 0.99 means they're almost the same. And this means you might not want to include the two of them because they practically have the same information. And in that case, James allows you to very easily remove one of the variables. You click the toggle button here. Now it's off, and this variable is not going to go into the model any longer. And you see the alert has disappeared from here at the right side. Other interesting things that James provides you is here the suggested actions. So if I click here, you see James is suggesting me to apply a transformation to some of the features. Now this is also where the artificial intelligence comes in, because James is learning that the data, the variables, since they have this long tail, James will be able to build a better credit model with this kind of transformation, the optimal binning. So if I click here and to bin all the variables, you see here the binning being done. And this will provide us better results. Now you see no suggestions here, but usually James would give you suggestions also, such as you have too many missing values, would you want to remove these variables? Or if you have variables that contain always the same value, you also have a suggestion for that. Or variables with too many categories, suggestions to put them together. And this is a little bit where, again, the artificial intelligence side comes in. We're not taking decisions for you, so James is not taking the decisions for you, but it's suggesting. And it's up to you, the end user, to know if you want to follow up and use the suggestions or not. But let's say we got 9 variables included, and that's the ones we want to include, and we want to include them with the binning and the transformations. I'm going to go and click Next. Again, a summary, the experiment, random forests. This is how we divided the data, and we have 9 variables. I'm going to click Run. And now we just have to wait. And this will take up to 20 minutes. I'm not going to wait now. I'm going to show you some results from other projects. But it's very fast, and what's happening in the background is, in our cloud, James is optimizing and building you the best possible credit score for this. And it's doing 50 iterations, so 50 different models, testing different hyperparameters, making sure we're not overfitting, and in the end we give you the best possible random forest algorithm that fits this data. Let's say you'd like to check out gradient boosting as well. So you could clone here. And now everything is already pre-selected, but I want to change one thing, which is the algorithm. I select the gradient boosting instead. And then I just have to click Next. We got all the same settings we had defined before. The variables, again, they're all already binned. So we got the same variable transformations that we have done. Here, again, the same bins. We have removed the variable with the too high correlation already. So I can just click Next. Gradient boosting, exactly the same conditions as the random forest run. And now I have to wait as well. It's going to start running, and in, I'd say, 15 to 20 minutes, we'll have the results for the two of them, and we'll be able to compare which one algorithm gives us the better credit model. If I go back, I'm going to show you now a credit model that has already been concluded. And that's here, this one. So you see a project with many models. We have different number of variables, different algorithms. And let me show you how the results look like. So these are the most important, in this kind of problems, the most important performance metrics. A Gini score, so 0.7 Gini score is already a very high score. That means you're very good in discriminating between good and bad loans. And a few other measures that you might already look at or you might not look at, but those are the state-of-the-art measures in the industry. You're also able to look at the variable importances, so how much each variable was contributing with a positive sign or a negative sign. You have a very useful scenario simulation tab where you see the distributions of the scores here calculated as probabilities of default, and where you could simulate different cutoff points. So let's say anything above 0.2, so 20% probability of default, I want to reject, and this will be my confusion matrix. This means these are all the good loans I accept. On the top left corner, bottom left, the bad loans I accept. So these loans will actually become charge-offs. top right corner, 15,000 loans are the loans which will be good loans, which I'm rejecting, and here are the bad loans I'm rejecting. So here the trade-off is, I don't want to have too many good loans I'm rejecting, but I don't want to accept too many bad loans. But that's probably a very strict cutoff point. I'd rather go somewhere more towards this side where I accept, okay, now 1,000 charge-offs, but I only miss out on 1,600 loans instead of 15,000 loans. And it depends on your business, on your different metrics, which cutoff point you want to choose, how much risk you're willing to accept, and James is here to help you simulate very easily what different cutoff points would look like. And lastly, for the scorecard you have here, well, the actual scorecard, right? So for each variable, how much points you get for each category. So let's say monthly income, if you have an income between $0 and $1,200, you get 49 points. A debt ratio, you got all these points as well according to the debt ratio you fall into. And then all these points add up and give you the score of this person. Now you see here, we could compare, for instance, a logistic regression and a gradient boosting model, which was the worst and the best model. And I could compare the results. And here you'd see the orange one being the gradient boosting with a way higher curve. This means the results will be much better. I'm much better. My underwriting is much better because I'm using a gradient boosting algorithm than if I'd use this more traditional logistic regression. And this is all around the model building. I'd like to show you also what you do once you select your model, how do you deploy it. And for that, we have a very easy deployments module that will integrate with your decision engine. This means, let me show you here. Clicking deployments. Let's look at this model. So we give you this, all the documentation on how you should integrate. So this is an endpoint. This is our API documentation, and it's going to integrate with your decision engine, as I was saying. And this was going to look like something like this. If I'm an applicant and I fill in an application form, here with some random numbers, let me send the application. This goes through your decision engine, which calls our API, and then the API response is this. So you get a PD, a probability of default, or a credit score, depending on your specific configuration. But also, very importantly, you get the variables that contributed to the decision. So the variables that made your credit score worse the most, and the ones that helped you the most, that got your credit score up. And this is, of course, very important for you to be compliant with all the rules where you have to explain people why you rejected their loans, and also for you to be sure that you're not that you're doing fair lending. That's something we're very concerned about. Lastly, we have also a monitoring module. So this allows you, let me show you here, to keep tabs on your performance, your calibration, or stability. So that means stability is, how does your through-the-door population look like in terms of, do you have the same kind of applicants as you had when you trained this model, when you created the credit model? For instance, you might have many more high-income applicants nowadays than before, and this means you need a new model because it's not applicable any longer. Or it might mean that you have inadvertently targeted a different population, and you might want to talk to your marketing team to target high-income applicants again. This will be something you could look at here, the stability tab, for instance here. Let me get this bigger, yeah. So here you see all the bars are more or less the same size. This means expected and observed are in line. I know there's a variable here exactly where you have a lot more people falling into the first bucket and not so more into the next bucket in the observed ones versus what was expected. This means you got to be careful, pay attention. There's something wrong with this variable. Also important is calibration. So this means if you estimate someone has a 10% probability of default, do actually 10% of those loans default. And that's important for you to assess your capital requirements, for you to have confidence on how much risk you're taking on. And this calibration module has these metrics you can see here on the left and also down here, which are recommended by the Basel Committee, and that's also the industry standard for controlling your calibration. And that's something that can help you, as I was saying, control your risk and make sure that you expected something and that's what's happening. Lastly, performance allows you to check if your Gini score is the same, so if the model has been running for a few months or 1 year, if you're still able to underwrite properly. If not, maybe it's time for you to build a different model again. And lastly, one thing I didn't show you here in modeling is once we build a model, so here let me show you gradient boosting, we have this reporting feature. So we click this download reports, and what this is doing is we automatically generate a report for you about the model you built. So we tell you which variables you're looking at, how does the model decide, what are the performance metrics, and a few more other things. Let me open it up. So you see here, this was all automatically generated. You see the ROC curve again, a few metrics, the scenario simulation you were looking at before. And this is a feature we built after we had the feedback from our clients that most of them were spending too much time on reporting, and that's not what we think you should be doing. You should be spending your time on value-added activities, and that's why we provide you this automatic reporting to save you time. And that's all about James. So we've been through the model building, we've been through deployment and monitoring, also covered a little bit of reporting. All of this is part of our James suite. Also important to note is we see our clients as partners. So we sell this software as a service module, but we also partner up with our clients to make sure they know how to use the software. We give them training, and we ensure that you get the results you're looking at. So it doesn't matter if you have a very good tool if you don't know how to get your results, and that's why we're also there to help build a very good credit risk strategy. Again, the end goal being increasing your acceptance rates, and there we've seen results with our live tests of up to 10% increase in acceptance rates and reducing charge-off rates or default rates, where we've seen results up to 30% decrease in charge-off rates. Moreover, if you're already building your own credit models and you've been using tools where it's very cumbersome to build the models and you have very repetitive tasks, you have to use code, James, with its very user-friendly interface, is also going to increase your operational efficiency by allowing you to build models in a few minutes or a few days instead of the typical 2 to 3 months lead time to build credit risk models. Lastly, a few of the questions we usually get are around the data. So we don't provide you external data. We help you connect to external data sources if you wish to, but we don't bring those sources in by ourselves. So all the data we use is your own data. And also we don't share your data with other clients. So your data is still your data, it's confidential, and it's not going to be shared. And I think that's all about James. If you're interested in learning more, I'd invite you to look up our website, james.finance, and there you can see another web demo similar to this one. You can also download one of our white papers where we give you a little bit more details on the technology behind it, James, the theory of the algorithms, and contact us if you want more information. We're here in Ohio, and we've been already working with one credit union. We're very looking forward to hearing more from a bunch of you. Thank you for listening, and I hope you'll be